If you think the biggest risks to the market right now are just regular old domestic inflation or the usual geopolitical tensions, well, you're definitely going to want to pay close attention today. We are jumping right into a high-stakes financial thriller that's quietly playing out behind the scenes of the entire global economy. We're talking about the yen carry trade and Japan's global financial endgame. And honestly, once we start unpacking this, you'll see that the sheer scale of what's happening is absolutely staggering.
So, right off the bat, we're looking at a pretty wild question. Could a seemingly tiny, almost insignificant interest rate hike over in Tokyo actually crash the massive global AI bubble? I know, it sounds totally absurd at first, but we're going to trace exactly how a single Japanese government bond is directly plugged into the existential threats facing global tech stocks and really the whole international financial order. Now, what's super interesting right now is this sort of schizophrenic market dynamic that's yanking the Japanese yen in two totally opposite directions. On one side, you've got the fundamentalists. They're looking at things like purchasing power and trade surpluses, and they're screaming that the yen is practically 20% undervalued, like a massive bargain just waiting to snap back. But then on the other side, you have the momentum traders. They're glued to the daily capital flows, betting the yen is going to completely crash all the way down to 200 against the US dollar. So who's actually right here? Well, it really boils down to how investors are looking at risk and yield. Because think about it, if the yen is really that cheap, you have to wonder why investors aren't just swarming in to chase the highest yield they can find among stable nations. The catch here is currency risk. See, when you buy a foreign bond, you aren't just buying an interest rate. You're actually locking yourself into this complex, multi-dimensional risk contract. If that foreign currency drops in value by more than whatever extra yield you're making while you hold it, it acts as what we call the great eraser. Boom. Your extra profits are literally wiped out.
The bottom line is that yield is really just the market's price tag for risk. Buying the highest yield out there isn't a free lunch. It's a guaranteed package deal of volatility. You aren't just scoring a higher interest rate. You're taking on super expensive hedging costs, hidden credit risks, inflation eating up your purchasing power, and these nasty liquidity traps where you suddenly find you can't sell when you really need to. You can't just hunt for the biggest number. You have to look for the safest return compared to the actual risks you're taking.
All right, let's move into Section 1, the yield paradox and the BOJ trap. We're going to look at the crazy tug-of-war happening inside Japan as long-term yields start to rise. The math here actually sets up a pretty brilliant double-win scenario for foreign investors. Basically, your total return is your bond yield plus however much the currency appreciates. So imagine you hold a Japanese bond yielding 2% and the yen goes up 5%. You didn't just make 2%, you just made 7%. All of a sudden, a rising yen makes those low-yield Japanese government bonds look incredibly attractive. But there is a huge trap here. A rapidly strengthening yen is an absolute nightmare for Japan's massive export economy. Think about giants like Toyota or Sony. The Bank of Japan might actually be forced to step in and weaken the yen just to save their exporters, which would instantly evaporate the exact currency gains those foreign investors were counting on. And that brings us to an absolutely mind-blowing number, $1.2 trillion. That is how much U.S. debt Japan currently holds. They are literally the largest foreign holder of U.S. Treasuries on the planet. And here's the kicker. To defend the yen from completely crashing, Japan has to tap into those exact reserves. It totally sets the stage for a terrifying global game of economic chicken. So how do you manage a $1.2 trillion weapon without blowing up the world? To defend the yen, Japan is opting for what's known as stealth liquidation. They're basically letting their short-term holdings mature naturally without rolling them over, which raises cash invisibly, totally under the radar. Why do it this way? Because the alternative is a forced liquidation. An aggressive, overt fire sale of U.S. Treasuries would cause U.S. interest rates to violently spike, which would crash the value of Japan's remaining bonds and spark some serious political fury from Washington. It is quite literally financial, mutually assured destruction. Japan absolutely cannot afford to tank the U.S. bond market because that would destroy their own massive savings. But at the same time, the U.S. cannot afford a chaotic, collapsing Japan without risking this massive global financial contagion. They're trapped, locked together. Let's zoom out a bit now to Section 2, the global margin account. This is where we get into the hidden gears running the world, the infamous yen carry trade. Okay, so here is the foundational mechanic that is secretly propping up everything, from emerging market debt all the way to those U.S. tech stocks you hear about constantly. Investors borrow incredibly cheap yen, usually paying around just 1% interest, and they take that nearly free money and use it to buy high-yielding assets all over the globe. For years now, the yen has been the world's cheapest funding currency. Basically, the entire global financial system has structurally been shorting the yen. But guys, this structural setup relies on a downright terrifying amount of risk. We're talking extreme leverage. Hedge funds are out there borrowing $4 to $14 for every single dollar of their own capital. Now mix in the insanely expensive options they need to hedge against the yen going up, plus the slow, turning a battleship inertia of massive pension funds. What we're looking at is basically a giant tinderbox, totally soaked in gasoline, just waiting for one single spark. And here is exactly how that sparks into a cascading doom loop. Step 1. The yen strengthens, even just a little bit. Step 2. All that extreme leverage suddenly works in reverse, and these massive margin calls start slamming the hedge funds. Step 3. To raise cash to cover those calls, these funds are forced to liquidate their easiest, most liquid assets, which means dumping U.S. tech and AI stocks. Step 4. They sell those U.S. assets to buy back the yen, which just causes the yen to rise even further, triggering even more margin calls. It's a brutal, self-feeding spiral. Which forces us to look at this very scary threshold. What actually happens when rolling over the debt is just no longer an option? According to financial stress tests, if Japanese bond yields cross into that 2.5 to 3% range, the math on the carry trade completely breaks. It instantly goes from a massive profit opportunity to a guaranteed locked-in loss. And when that happens, everyone rushes for the exact same exit door at the exact same time, causing a total global liquidity freeze. So, who's actually driving this bus? Let's get into Section 3, Japan's hidden agenda. Are they just a victim of global forces here, or is Tokyo actually executing a highly calculated strategy? Look, diplomatic levers might be able to stop government selling. The US can pressure the Japanese government all day, but there is a massive difference between government selling and private selling. If Japanese private pension funds and insurance companies look at the yields at home and decide, hey, these are finally good enough, they're going to initiate a free market institutional repatriation. They will happily dump US dollars to buy yen. And that kind of massive private capital rotation is completely outside of Washington's control. So why in the world might Japan actually want to trigger this? Because they are stuck in a brutal inflation trap. A weak yen imports really painful inflation for everyday Japanese citizens, but a strong yen absolutely kills the corporate profits of their biggest exporters. And here's the trickiest part of this balancing act. If the government raises rates too fast to save the yen, the interest payments on their staggering 200% debt to GDP ratio explode, which triggers a full-blown sovereign debt crisis. They are desperately trying to thread the needle, generating just enough inflation to shrink that debt burden without accidentally going bankrupt in the process. All right, let's knock down all these dominoes in Section 4, a financial thermonuclear detonation. We're going to look at what this ultimate unwind actually looks like in real time. If this unwind actually gets triggered, we hit what analysts are calling the triple threat. First, you get the spiraling yen carry trade unwind we just walked through. But right alongside that, the sudden evaporation of all that cheap yen funding acts as a massive global margin call. The crazy capital expenditure that's been fueling the AI bubble suddenly becomes way too expensive to maintain, risking a severe dot-com-style crash. And at the exact same time, you have the completely opaque, highly leveraged private credit market, which, by the way, looks terrifyingly similar to the toxic assets of 2008, beginning to default. The sheer gravity of those three massive events hitting simultaneously, you really can't overstate it. If Tokyo looks around and concludes that the current system is just guaranteeing a slow, agonizing collapse for Japan, they might actually decide that a controlled demolition of the global carry trade is their only real escape hatch. And if Japan flips the board to save itself, the velocity of capital flow in a major algorithmic unwind would completely overwhelm the Federal Reserve's ability to intervene. Honestly, the Fed would essentially be trying to stop a flash flood with a garden hose. The results of this would be completely binary. On one hand, yes, a short-term catastrophe for sure. We're talking an immediate liquidity freeze and a violent market crash. But there's a really fascinating counter-perspective to consider here. This massive deleveraging event might actually be exactly what's needed for long-term health. It would act as this brutal, necessary mechanism of creative destruction, wiping out the deadwood, resetting those astronomical tech valuations, and finally putting an end to all those zombie companies that have only managed to survive because of a decade of cheap, easy debt. Which leaves us with one final, incredibly critical question to chew on.
Are we moving out of this comfortable era of policy-managed stability and stepping directly into an era of regime-shift volatility? Given all the structural fragilities we've uncovered in the global margin account today, you have to ask yourself, is a massive, uncontrollable system reset not just possible, but actually inevitable? Something to think about. Thank you so much for exploring this with me on today's Explainer. I highly encourage you to keep your eyes on the yen going forward because it just might be the most important chart in the world right now.